if you want to trade British pound, position open at 136.895.
Washington Post this morning in an op-ed piece, just a clinic on what he thinks could happen, just raising some questions on the size of this package that the Democrats and this new government under President Joe Biden are trying to push through. From New York City this morning, good morning. Alongside Tom Keene and Lisa Brammitz, I'm Jonathan Ferro. We are 12 minutes away from a payrolls report in the United States of America, and we have an equity market at all-time highs. A record high coming into Friday. Futures up 15. Tom, we advance about 0.4 of 1%, and the bond market, bond yields are coming with it.
Let's get right to it, John. Let's talk to the right guest at the right time. Here's the backdrop. Lawrence Summers clearly making a tone to the progressives of economics. James Glassman was in the crucible of Northwestern economics with Robert Gordon. He's got a measured feel for the limits of the American economy. And yet J.P. Morgan is out with a huge number, 400,000-ish on jobs. That's where Glassman is, at least. Jim Glassman, you're optimistic on this report. Why?
I tell you what, we were surprised by the weakness last time. There was a lot of hospitality. These monthly numbers are very volatile.
Yep.
We don't expect anything really good until we can lift restrictions on hospitality and get kids back in schools, because that's where the problem is. So that's coming. That's in the next several months.
Jim Glass.
By the way, yes.
I want to get to the contingency plan. I know you want to talk about Lawrence Summers right now. Out there, wherever it is, why do you take issue that we do not have a contingency plan?
We have a contingency plan, and it's been visible, actually, for last year. Number one, if to the extent that the help goes to the unemployed people, it triggers off automatically when these people when we lift restrictions and they can go back to their jobs. All that money we're spending through the unemployment insurance system will trigger off. But secondly, what is it that we all buy? If we overdo the stimulus and drive consumption, a lot of what we're buying is made from overseas. And so we have all kinds of safety valves in our system that and it helps our trading partners. And by the way, this is why when you look at what happened to China last year, you wouldn't even know there was a pandemic, because China's economy grew 6.5%. And I think that tells you how connected we all are. And we don't live on an island. We live in a world economy. And if people have too much stimulus, too much money to spend, they're going to be buying things that are produced by our trading partners. And the system, the global system, needs a lot of help. So Jim, I really don't think there's much risk of overdoing this.
Wait, Jim, I want to make sure that I understand what you're saying. And to be clear, I mean, China's actual official numbers have been questioned by the likes of China Beige Book, et cetera. But there is a question that you raise implicit in your comments that any stimulus in the U.S., especially in the form of checks to families that can get spent on goods, will go to international causes, that will go to our trading partners. Do we have a sense of how much?
If we can't produce it, it goes to our trading partners, and it's a pay-it-forward story. Because if it helps our trading partners, we're all in the same soup. And if it helps our trading partners, it's going to help us also down the road.
John,
I think the system has a lot more flexibility.
John, this is so important, what Dr. Glassman brings up. This is the key distinction of modern economics, John. The open versus closed economy distinction is the heart of the matter.
I know this is not where you're going, but I'll take a more literal interpretation of what you're talking about, because the sequencing of how we reopen, Jim, has shifted. And these economies could remain closed. And what I mean by that is international travel may not reopen for a long time. Jim, how are you thinking about those issues right now for the next year, the next 2 years, the next 3?
I think you'll be surprised how quickly we get this behind us once we feel like we're protecting our parents and our grandparents, because this is a medical problem. We have a medical answer now. And the minute we all feel safe, we're going to be so eager to get back to doing a lot of what we were doing. Get to the restaurant, see your friends, fly, take your family to a vacation. And by the way, if you're a business traveler, you can't manage your supply chains virtually. I've talked a lot with folks about this. It is impossible. So I think once we feel safe, you're going to be surprised how quickly we go back to that. And this air travel is going to be one. It'll take a while, but I think you're going to be surprised.
Let me put you on the spot. Let me give you a scenario. Here's the scenario. There is an English gentleman with a flight booked from JFK to Milan, Malpensa, the end of August. Does he get that flight without needing to quarantine on the other side?
If the vaccines work, if we've got this out, and we're watching it play out big time in the U.S., if the vaccines, and there's more and more vaccines coming into the pipeline, if that medical answer gets a grip on this, then I think you'll find, that he'll be able to do it without quarantining.
Dr.
This
Glass,
is not the new normal.
Yeah,
the new normal is, what does it look like when we got this nightmare behind us?
Dr. Glassman, what do we do with the 9 to 10 million that are still unemployed? I mean, what is the immediate income replacement for their rents and their landlords' mortgage payments? What do we do on that in February, not March?
Yeah, no, that's what this fiscal measure is designed to do. We did a good job of this last year. The reason there's a disconnect between unemployment and income is because that income transfer from the federal government temporarily helped people. But I think the thing to remember, the big problem, the 10 million people who are the jobs that are disappeared, a big chunk of these, by the way, are tied to the school system. 3 million jobs are related to private and public education. 4 or 5 million hospitality. So the key here is give them a lifeline until we've we can lift restrictions on going to the restaurant, going to the bar, going to the ball game. That's the real problem. I think the reason we're all becoming more hopeful is because we now see the third wave of the infection is fading, and we've got vaccines building. So there's a reason to be hopeful that in the next 3 to 6 months we're going to start to get our hands around this. And so we really just need a lifeline for these folks temporarily until we get there.
Jim, great to catch up, sir. As always, Jim Glassman there of JP Morgan Chase, the commercial banking head economist. We are counting you down to the payrolls report. It comes in about 5 minutes' time. Here are the estimates. 105 is the consensus estimate in our survey. The spread is wide, wide, wide. The highest estimate, positive 400K. The lowest, negative 250. The previous read, Tom, negative 140. We're looking for a snapback in 5 minutes.
And, John, I'm going to look what Julia Coronado is looking at, which is labor participation of that middle age group, not ancient like me. I think it's 25 to 54. I can never memorize those numbers, but I need to see a lift in that core labor participation statistic.
This market has a lift right now, so let's whip through it and get you set up. Your market, higher, record highs on the S&P 500. We advance, but potentially a fifth straight day of gains, up by around about 18 points. We advance a 0.5%. In the bond market, your treasury, lower, yields higher. Your 10-year, 117. We're up about 3 basis points. Yields are up. The curve is steeper. Equities are advancing, and the dollar is just a little bit weaker against the euro. Euro dollar 119.83, up 0.1%. The payrolls report just moments away right here on Bloomberg. The estimate, 105. The print just around a corner. Heard on Bloomberg Radio, seen on Bloomberg TV. This is Bloomberg Surveillance.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
From New York City, your payrolls report is seconds away, and going into that print, your equity market is at record highs. The S&P 500, positive 16 points. We advance 0.4.
I'm placing a stop on profit for British pound at 136, 900. Well, actually, I will put at 136, 9. Trying to find the resistance level for this pair. So hold on a second, I'll try to find out resistance level. Okay, stop I place in stop on profit at 136.975. Okay. I'm still holding it. Okay, let's wait and see. Yeah.
Enough. So that little tension at the bond market, at the long end playing out.
Yeah, 1.1549 right now in the 10-year yield. Michael McKee, you're doing a great job. It's so much harder to do this report now than when we had the older procedure pre-Trump. Mike, I want to go to what's going to be the money question today. Obviously, the White House is going to talk up 6.3%. With what our viewers and listeners see out there, how is it possible the unemployment rate could move down to 6.3%?
Well, we did see apparently the labor force participation rate drop a little bit, and the number of people in the labor force falling back a little bit.
Is that hopelessness? Are they dropping out because it's just they've given up?
Well, they've given up in the short run. I think if you were a restaurant server, for example, you would know that in January there probably weren't going to be jobs, so you wouldn't look, but it doesn't mean you're necessarily going to be a long-term dropout from the labor force, because as COVID restrictions start to lift, you can hope that some of the restaurants start to reopen. Let me point out one thing here. I just did a little bit of math on the non-seasonally adjusted numbers. we lost 133,000 jobs in terms of non-seasonally adjusted. So the seasonals did add to the number of jobs in terms of seasonally adjusted, and takes us to just 49,000. So we did get that big gain, but we lost more jobs on a non-seasonally adjusted basis than probably anybody really anticipated.
Mike, how does this change the narrative in Washington right now?
I don't think it changes it a whole lot. I think what you're going to get is Joe Biden coming out at 11:30 today and saying this proves the need to get aid to the people who aren't working and to help the school districts so they can reopen and more of these people can get jobs. But it's kind of all, the debate now moves to the Larry Summers camp. And I mean, whether you want to believe Larry or not, his op-ed today, but it's going to be how you put this together, how you target it so that you get the most aid to the most people for the least amount of money and politically get it passed. And that's going to be an interesting task for them to talk about in the National Economic Council and at Treasury and places like that over the next couple of days.
Michael McKee, thank you so much. Much more on this through the day. I just looked at the number, John Farrell, that I always look at, which is 27-week unemployment. And the headline for me on a number that's maybe dated and outside the pandemic, it hasn't come back. I mean, it's spiked up, not like in 2007, 8, 9, but it just won't improve. That number's still a very difficult number. John, what else do you see in the markets?
The dollar fading, euro dollar back through 120.
Oh,
so
important,
it moved through
yes.
120, up about 1/3 of 1%. And the move at the long end fading too. So yields unchanged on a 30-year, basically, on a 10-year yield, up by almost a basis point on the session. But that's faded, that move higher, since this number dropped about 6 minutes ago. But I still think, Tom, still got a couple of things to reconcile here for the long end of the yield curve. And I wouldn't make too much of a read across in the last 5 minutes or so off the back of this payrolls report. This package down in DC is massive. It's huge.
Good morning on radio and television. Right now, Jeffrey Rosenberg joining us with BlackRock, their portfolio manager of systematic multi-strategy. Jeff, how is the BlackRock call nuanced in the last 2 weeks? The cacophony of noise and what we see within this jobs report. How is the yield call morphed for BlackRock?
Well, it's really, as Jonathan was just.
I'm going to move my stop on profit for British pound at 137.015. Okay.
Of the impact, the expected impact of these very significant fiscal policies. I'll use the plural here because the focus is on the first one, the 1.8, 1.9 trillion, the fiscal plan to address COVID, but it will be followed by a second one, which is further economic fiscal interventions. And so that's really the focus here. And that's what's changing the outlook. It's steepening of the curve, increasing inflation expectations, modestly higher interest rates.
Let's talk about that a little bit more. Front end of the yield curve pinned to the floor, 10, 11 basis points on a 2-year yield. That's going nowhere for a long time unless the Fed changes course. Jeff, as you say, all the flexibility is the long end. Through the belly out to 10s, out to 30s. That's where you get this flexibility, this ability to shift higher in yields. How self-limiting do you think a sell-off could be?
Well, you know, it's about the pace of the increase in terms of it being self-limiting, right? What limits it is there a degree of increase in long-term interest rates that starts to have a meaningful impact to expectations in the real economy? Where does that mostly show up? It's through the transmission to the housing market, right? The big story in the real economy, the big beneficiary of this interest rate structure has been housing. And so if you had a significant disruption there in terms of the steepening of the curve, that's when it becomes self-limiting, because then the market starts to worry that it's gone too far, that the Fed would then ramp up its intervention. That's the first area. The second area, real quickly, is financial conditions, right? A too aggressive move in terms of the back end of the curve, steepening, taper tantrum kind of concerns that starts to disrupt financial intermediation, and the stock market, most importantly, probably triggers some kind of first verbal intervention and maybe, a larger intervention if the disruption is larger. So that's the way in which it's self-limiting. This kind of gradual bear steepening that doesn't disrupt those two elements, can be absorbed.
The bear steepening that we're talking about, the longer-term yield going up, is it because that the supply of treasuries that the U.S. is going to be selling is going to be going up so significantly to pay for all of this fiscal stimulus? Or is it because inflation is expected to tick up with all the money circulating in the economy?
Well, it's a little bit of both. The supply-demand imbalance is, or balance, I should call it, because it gets met. The question is at what price, and that's really a reflection of the total of the demand. The key is that the Fed is the major purchaser there, and so the expectations are that they'll maintain that. This year, a lot of question and debate about the pace of tapering and eventually halting those purchases. But what we've seen from Fed officials recently is, no hurry to talk about and really tamping down any discussion about that. So that Fed support really helps to offset the increase in expected supply. And then the long-term inflation expectations are ticking up. We've seen that certainly in terms of break-even inflation. And that's a modest increase in a return to some term premium in the back end of the curve, but it's a very modest increase relative to historical levels.
Jeff Rosenberg, thank you so much. Greatly appreciate it. With BlackRock this morning, John, futures up 16.
Yeah, futures doing okay. This bond market move's fading though, Tom. I'm going to run. Going to get to the other studio in just a moment and catch up with Heather Boucher of the administration, Tom. So looking forward to that conversation with the Council of Economic Advisors member a little bit later this morning.
And they are in practice as they get used to the Pharaoh grilling on Jobs Day. Mohammed Al-Arian joining up there as well. Mike, I've just looked at the 27-week unemployed chart, sort of the duration chart, which is quaint. It's pre-pandemic. Do we see in the data now the truth of the American labor market? Or when everything's said and done, is it ambiguous what we see because we don't see the angst of 09, 10, 11, or maybe we don't see a better America right now?
Well, this, remember, has happened in a very short period of time. You can see the previous peak took place over a longer period of time. The number of people moving into that long-term unemployment continues to go up every month. It tells us, what the jobless claims numbers are showing us, that people who lost their jobs aren't coming back very quickly into the labor force.
Can stimulus help with that?
Stimulus can help with that, but really, to come back to what we always say, it should be tattooed on our foreheads. It's the virus that decides, because it's going to be when the companies are able to reopen and people can go back to work. We lost almost 400,000 people from the labor force this past month. And there were a lot of shutdowns. And of course, we did have some storms during the month. And so between those two things, you have people who just either couldn't get to work or didn't have a job.
Yeah.
Now, a lot of those jobs may come back when we start to open up again, and a number of states are starting to do that.
I'm struck by the unknowns here, Mike, and I was struck by what we were talking about with seasonally adjusted, non-seasonally adjusted, and how much the scenario has completely been shifted on its head because of this shift to online shopping, the shift away from brick and mortar retail. I mean, do we have a sense of how much the economy is transforming in a permanent way, and whether people are able to find jobs in other avenues to replace those that are going away?
The second thing they teach you in economics classes is that this time is different is a terrible thing to say, but it does appear that a shift is underway. Now, we all bought groceries and stuff online because we don't want to go out shopping, but will that change as we go back and the economy opens up a little more? I assume that people are going to want to go to stores and try stuff on if they can. Part of it is a social thing, being out. So I'm not sure that the degree to which we've shifted online will stay, but the convenience and the cost aspect of it is probably going to keep us moving in that direction, basically accelerating a trend already underway.
Michael McKee, thank you so much. What a nuanced and interesting jobs report as well. And the market giving us that angst, that pullback, and it's really come back nicely the last 10 minutes. Yield 1.1497, maybe not what we saw at 920, but certainly pretty good. On policy, we went out in our Rolodex and said, who is someone who did not sleep last night? That would be Henrietta Treyes of Veda Partners, looking at the festivities of the Senate and the path towards a new kind of stimulus. Henrietta, first principles, explain to our audience the distance that the Democrats are from filibuster.
Well, technically speaking, they are very far from the filibuster, but practically they are right up on it and getting closer every day as we go through what I expect will be a very generous interpretation of something called the Byrd Rule, which prohibits any policy agenda items from passing with just 51 votes. So we're very close. At about 5 o'clock this morning, the Democrats unlocked Reconciliation Authority, which will allow them to get their stimulus out sometime in the next just 4 weeks here, maybe 5, to provide as much as $1.9 trillion in stimulus to the U.S. economy with only Democratic votes.
Henrietta, does the senator from West Virginia apply the Byrd Rule or the marginal Byrd Rule? And can Republicans, the minority, adjust the Byrd Rule to steer reconciliation in their direction?
Well, the most important person technically here is going to be the parliamentarian, a woman named Elizabeth McDonough, and she is going to be the one who tells the Democrats how much they can get away with. In practical purposes, though, Senator Manchin is absolutely someone who is going to be able to say, maybe you can, twist the arm of the parliamentarian, but I'm still not going to vote for it. That would apply to things like getting the direct payment to individuals out to people who he thinks are in an upper income threshold, or moving the minimum wage to $15 an hour. Last night, there was a vote that got rejected, or supported rather, from the Republican side, saying, we're not going to increase the minimum wage and potentially hurt small businesses during a pandemic. And there was Democratic support for that, which points a picture of, even if Budget Committee Chairman Bernie Sanders and his Chief of Staff, Bill Downster, who is extraordinarily experienced in the reconciliation process, if Manchin's not going to vote for it, or Senator Sinema, or Warner, or Tester, or Kelly, there is nothing the Byrd Rule or tweaking the Byrd Rule can do to overcome what they will not do. So the restrictions there on policy are still very much in place by the moderates in the Democratic conference.
So basically, Biden's hope for a bipartisan Washington seemed to be fading as time goes on, rapidly fading. And there is a question of whether people's hopes for a second round of stimulus after this one, that perhaps they've gotten a little ahead of themselves, given the lack of willingness to really work together to push something through. Henrietta, do you think that it's less likely that we're going to get some sort of infrastructure spending if the Democrats push this through unilaterally?
I think it's really difficult. One of the things the street is factoring in is that Democrats are going to plow through the stimulus bill, move to an infrastructure package, and offset it with tax increases on corporations and individuals. There's just no planet where you have the votes for that. So I think the difficulty of getting another budget through, holding another all-nighter on Vote-A-Rama, and this time doing it on infrastructure spending, is going to be even more complicated than this package. So if we have 100% odds that this bill will eventually go through, whether Republicans vote in favor of another stimulus bill or not, it's going to pass. The infrastructure package is going to be even harder. And then some Democrats you talk to would say, and then we want to do a third bill after that for fiscal year 2023. And it's really hard to thread the needle for that component, especially as we get into, the 2022 midterm elections, which are just going to start around March of next year. So yeah. I think that each subsequent path forward on a partisan basis does get more difficult. But what we've seen from this president is that they're extraordinarily rigorous in their messaging. And so there's no question that we're in, COVID relief week. And right. I would be, eager to see what infrastructure week looks like under this president.
Just on a technical note, Henrietta, you were talking about taxation. And can you talk about the reconciliation process and whether Congress has to pay for some of the measures that they pass if they go through reconciliation rather than a bipartisan measure?
Great question. A major source of confusion on the street. What happened last night is the Democrats authorized $1.9 trillion in deficit increases. That is over a 10-year budget window, and that means that over 10 years, Democrats or Republicans, if they want to vote for the bill, can authorize $1.9 trillion in deficit increases, and they do not have to pay for it. Do not. There are no taxes in this bill. Indeed, there was a vote offered by a couple of Republicans that said, we will not raise taxes on small businesses during a pandemic, and it passed 100 to 0. So there are no taxes. This bill will not be offset by tax increases either at the corporate or individual level. The deficit spending will be incurred during that 10-year budget window, and no taxes will be increased as a result of this bill.
Well, some of the detail there, Henrietta Trey is a pro at Veda Partners there on fiscal and many conversations to come forward as well. Futures up 18, down a little bit off the shock of a difficult one-month statistic with, frankly, grimmer revisions as well. And then we've bounced back nicely, not up 20, but up 18. SPX Dow futures, the level 31,085. Gina Martin-Adams with us right now of Bloomberg Intelligence to review the equity market. Gina, we're what, halfway through earnings season? What are we going to learn next week on earnings, and is that the heart of this rally?
Yeah, I think it's been a really interesting earnings season because the first half of earnings season was really characterized by companies' remarkable beats to expectations. I mean, when we came into this earnings season, analysts were forecasting a 10% drop in EPS year. Season analysts were forecasting a 10% drop in EPS year over year for the existing constituents of the S&P 500. We're tracking a 1% decline. By the end of next week, I expect that number to be positive. So really, really strong resilience on the part of companies was the story. That translated over the course of the last week, and I expect will continue to translate over the course of the next few weeks of the tail end of earnings season into upward revision to forward forecasts. And I think that that was a key moment for the stock market, which in the early parts of the earnings season had been in a consolidation phase, certainly not rewarding beats to expectations. But over the last week, we've seen a remarkable turnaround in performance for the stock market at large, back towards cyclicals, back towards risk. And I think that's because we finally started to see analyst forecast estimates for 2021 growth improve. Even with the beats to revenues and EPS, analyst forecasts are moving up for the year ahead, which is quite remarkable considering the extent of the beat. And I think that will be what the market sort of keys on over the course of the next few weeks.
Gina, how much of that upward revision to expectations for this year's profits has already been baked into valuations?
Yeah, well, it's interesting because all of the fourth quarter beat appears to have been baked into valuations. What is not apparently expected is what's happening on 2021. And that's why we're seeing stocks move higher, is a growing confidence that analyst estimates, which are now for 24% growth in EPS in 2021, may actually be a little bit too light as companies continue to guide us toward much better than expected realities and much better than expected forward earnings growth. I think there's been a lot of chatter in the market about inflation. So we actually did go through and look at inflation mentions in company transcripts as well. And we found some interesting information there, and that is companies are even mentioning inflation risk. They're starting to mention it, but they're mentioning it at about a third as much as they did back in 2019. So what I think is going to happen over the course of 2021 is we're going to find out that analyst expectations for margins are actually quite low. They're starting to improve their expectations for revenue growth, and that's feeding through to the bottom line. What I would anticipate is if we don't get a ton of inflation pressure emerging, companies are going to produce much better than expected margin growth, which is likely going to increase that ultimate earnings growth prospect for 2021 much more than analysts had anticipated.
This is fascinating, Gina, because a lot of people talk about inflation. They talk about the potential for higher yields and that how that could eat into valuations. But you're saying on the other side of the equation, companies are seeing inflation that isn't ticking up that much, so their margins could be bigger than are currently baked in. On the first side of that equation, though, at what point do inflation expectations start to really create a trigger for valuations despite the beats, despite the increased forecasts?
Yeah, I think, frankly, we've got to see at least a tripling. Wow. Just based upon where we've been in the past and when inflation has started to creep into becoming a problem for the S&P 500. The last time we saw that was in the middle of 2018. Recall in the middle of 2018, margin forecasts peaked. As margin forecasts peaked and started to come lower, that's when the market started to enter a period of distress. So what you look for is a margin forecast peak. Just based on company transcript mentions of inflation in the loan and the rolling pace of inflation, the lack of wage inflation that we saw in the jobs report this morning, all of that in summary suggests to me that there's very limited risk to margins coming from inflation until we get to a much, much faster pace of growth.
Gina, thank you so much for the appearances today, leading our coverage of Bloomberg Intelligence on the equity markets and in the stock market. Gina Martin Adams here. Again, the level's 3883. Again, I mentioned S&P 4000 is a round number. Dow 31,090 on level. NASDAQ, are we looking at 14,000? Maybe not yet, but a nice lift to the market as well. Lisa, one of the things that has not come in is the VIX. You know, it's like a Dean Kernick kind of question, but the VIX at 21.61 really ought to be at 19, or dare I say 17. It's not.
Well, policy uncertainty, and I would say it's not policy of the Federal Reserve, it's the policy of Washington, D.C., and how much that could affect markets. And I say to Tom, I mean, honestly, if Congress passes a $1.9 trillion stimulus, what does that do to the rates market? What does that do to inflation expectations that are already at the highest level since 2018, Tom?
Well, and again, I'd read the Summers essay as a clinic on whether you agree or disagree with Professor Summers, the idea of the dynamics that we will see forward as well. Lisa, we've got to turn to the Super Bowl. Are you going down to Tampa? I'm sorry, we've been so busy. Are you going to Tampa?
You should be sorry. Yes, of course, I'm taking your private jet.
Full
you lent
team
it out
coverage.
to me. Yeah.
No, well, actually, Riley from St. Louis has a jet. She's already there. Burn Stakeout last night, folks. This is news you can use. I attended Yankee spring training. Soriano was just phenomenal. You look across from Yankee spring training over to the stadium and the distance, and this is set back from the ocean in Tampa. And for those of you, I'm saying this for Pharaoh, who I know is listening, John will be there. And it's important that John understand Burn Steakhouse is the only reason to go to Tampa, and it's 4.3 distant miles away from the stadium. Leave the game early because Brady will be, Lisa Brady will have it sealed up by second half.
Oh, yeah. Well, we'll see about that. I think that it's going to be interesting to also see some normalcy come back to the world as 2021 starts to perhaps get a little bit more back to something familiar to pre-pandemic days.
We're getting there. It's been interesting. Whatever your politics, it's been an amazing 3.5 weeks off the inauguration. There'll be a reassessment. John Farrow, and speaking to the White House, Heather Boucher will join with the Council of Economic Advisors. A first look from the Biden administration for Bloomberg on this Jobs Day. Futures up 18. Stay with us on Bloomberg Radio and Bloomberg Television. Good morning.
Position closed on British pound. Well done, guys. Anybody, all of you who follow my trades, we did well, right? All depends how much broker pays you per pip, yeah? You can have 5, 10, 20 pounds. In our case, we're professional traders, so we have 100 pounds per pip. It's good.
Focusing on is not so much what goes inside the cars of the future. So they're not working on doing a self-driving car or an autonomous vehicle themselves, but rather they're focusing on the surroundings. So everything that's going to go on outside the vehicle in the future. So that's sensors, cameras, radars that are embedded into roads, street signs, traffic lights, bus stops, infrastructure that's going to provide information, something to help the vehicle know what's going on around it, to help it.
Just I want to point out, it took us less than an hour to make this profit. So this is good. Anybody who doesn't have yet our strategy, you can get it. By the way, I have right now 1 hour trading course on Wednesday. So please go, you can see on the red colored sticker site, address where you can register and you can have a course together with the strategy, how we make profit, how we trade, what strategy we use, what indicators, all of these you can find for the course that will be live on Wednesday next week.
Sort of technology landscape has gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.